Hello everyone and welcome to another episode of FinEase, an initiative by the BAF department of M.L.Dahanukar College of Commerce, where we explain finance with ease. In today's episode, we will talk about FDI. You may have heard about this term, but today we'll see about it in detail. Investment means to invest our money somewhere from where we get return on investment. Now, what is FDI? FDI or foreign direct investment is an investment made by a firm or individual in one country into business interests which are located in another country. Generally, FDI takes place when an investor establishes foreign business operations or acquires foreign business assets in a foreign company. One important feature of foreign direct investment is that an individual or business should own more than 10% of the foreign company. Let's take an example. A company having its headquarters in the USA invests fund in an Indian company having a capital of 10 lakh US dollars. The transaction will be considered as an FDI only if the American company invests at least 1 lakh dollars. Otherwise, it would be taken a part of their stock portfolio as the investment was less than 10%. Now let us see the types of foreign investments. The first one is horizontal FDI. Horizontal FDI means investments of fund in the same industry as the original FDI investor. For example, we can take the example of Burger King India, where over half the shares are held by Burger King USA. These both belong to the same industry and hence it is horizontal FDI. The second is vertical FDI, which occurs when investment is made within the supply chain of a company. Vertical FDIs are further categorized as backward vertical integrations and forward vertical integrations. As an example, if the Swiss coffee producer Nescafé invests in coffee plantations in Brazil, the investing firm purchases a supplier in the supply chain. This is called as backward vertical FDI. Inversely, if Nescafé brought a grocery mart brand, this will be an example of forward FDI. The third type we come to is conglomerate FDI, when investments are made in two completely different companies within different industries. These transactions are called as conglomerate FDI. For example, Samsung, the South Korean multinational company, is primarily a manufacturer of smartphones, but it also holds stake in companies that build ships, undertake construction projects, and are involved in businesses that include food processing, textile manufacturing, insurance, financial products, and consumer retail. In fact, they also operate a theme park. The last type of FDI is platform FDI. In case of platform FDI, a business expands into a foreign country, but the products are manufactured are exported to another third country. For example, the French perfume brand Chanda set up a manufacturing plant in the USA, but it exports its products to other countries in the America, Asia, and parts of Europe. That is an example of platform FDI. Now let us look at the importance of FDI. Foreign direct investments is critical for developing and emerging market countries as companies need multinational funding and expertise to expand their international sales. They also need private investment in infrastructure, energy, and water to increase the jobs and wages. The UN has also promoted the use of FDI to combat the impact of climate change. Trade agreements are a powerful way for countries to encourage more FDI between them. Let's look at some pros and cons of foreign direct investment. Foreign direct investment diversifies investors' portfolios. It also promotes stable long-term lending between countries. It provides financing to developing countries, and it also provides them technology. However, there are few cons of FDI too. FDI is not suitable for strategically important industries like defense and communications. Investors may also have less moral attachment, which may lead to unethical access in the local markets and exploitation of labor. Now let's have a look at the Indian scenario. Economic liberalization started in India during the 1991 economic crisis, and since then, FDI has steadily increased in India, which has subsequently generated more than 1 crore jobs. A recent development in the FDI sector happened on 17th April 2020, when India changed its FDI investment policy to protect Indian companies from opportunistic takeovers and acquisitions due to the current COVID-19 pandemic. According to the Department for Promotion of Industry and Internal Trade, while the new FDI policy does not restrict markets, the policy ensures that all FDI will now be under scrutiny of the Ministry of Commerce and Industry. There are two routes by which India gets FDI. One is the automatic route. By this route, FDI is allowed without prior approval of government or the RBI. The second is the government route, where prior approval of the government is needed. The application needs to be through the Foreign Investment Facilitation Portal, which allows facilitation of it in a single window clearance of FDI. There are some sectors where 100% of the investments can be made through the automatic route. They include airports, automobiles, broadcasting services, chemicals, e-commerce activities, etc. There are also some sectors where 100% of the investment needs to be through the government route, that is print media, mining and mineral separation, and retail food trading. Then there are sectors where the investment can be made through automatic route but must be through the government route if it exceeds the set limits. For example, the sectors like biotechnology, defense, healthcare, and telecommunication have these limits. The sector of services, which include banking, insurance, non-financial business outsourcing, courier, tech, testing, and analysis, is the sector which gets the most amount of FDI inflows in India. Recently, India has seen an increase in its inbound equity foreign direct investments. The FDI grew by 40% to $51.4 billion in the April to December period. Policymakers attribute this rise mainly to US companies continuing to channel funds into India as India aggressively tries to seize global supply chains that left China in the wake of the current coronavirus pandemic. Continuing outreach by states have also helped push up the FDI. Industrially dominant states such like Gujarat, Maharashtra, and Karnataka have continued to attract the most FDI. The government has continued to push states to seek more opportunities on their own by asking each state to create and submit their policy on seeking FDI to the Niti Aayog. All of you must have learnt a lot about the general overview of FDI as well as the Indian scenario and the reason for recent increase. Don't forget to watch our other videos to learn more about finance with ease with FinEase. Till then, goodbye.